The bank manager laughed when I asked for a loan. He said, "We don't help people like you." I calmly took out my black card and made a call. I bought the branch and fired him on the spot. That happened on a Wednesday afternoon in a First Community Bank branch on Meridian Street in Indianapolis, Indiana. The manager's name was Greg Paulson. He was about 50, khaki pants, a blue tie that was slightly too short, the specific confident posture of a man who had been the most important person in a small room for a long time and who had started confusing that small room for the whole world. I had walked into his branch at 2 in the afternoon with a loan application, commercial real estate acquisition, a warehouse property on the southeast side of Indianapolis that I wanted to purchase for my logistics company. The numbers on the application were real. The business was real. The revenue was real. Everything on those pages was accurate and verifiable, and the loan was secured against the property itself plus additional collateral. He looked at the application for about 4 minutes. He looked at me over the top of the papers. He said, "Mr. Watkins, First Community serves a specific customer profile. We focus on established relationships with clients who have a track record with our institution." I said, "I can open accounts here. I am prepared to move significant deposits to establish that relationship." He said, "That is generous, but our commercial lending division has guidelines that we follow closely." I said, "What specifically in my application falls outside your guidelines?" He looked at me. He said, quietly, with the specific dismissiveness of someone who had decided the conversation was already over, "We just don't help people like you." He said it quietly. He said it like it was a policy, like it was a statement of fact rather than a judgment wrapped in a policy-shaped container. I looked at him for a moment. I said, "I understand." I stood up. I picked up my application. I walked out. I sat in my car in the parking lot and I took out my phone and I made a call to my attorney in Chicago. I told him I wanted to know everything about First Community Bank's corporate ownership structure, their financial health, and whether any of their branches were available for acquisition. He called me back in 40 minutes. He said 3 of their branches are underperforming. The holding company has been looking for a buyer for the Meridian Street location specifically. It is a liability on their books. I said, "What is the number?" He told me. I said, "Make an offer today." I went home. I made dinner. I went to bed. 2 weeks later, I owned the Meridian Street branch of First Community Bank. On the morning of the closing, I drove to the branch. I walked in. I went to Greg Paulson's office. His assistant was at her desk outside, and she looked at me with the specific, uncertain expression of someone who recognized me but did not understand why I was there. I said, "Is Mr. Paulson in?" She said, "Yes. Do you have an appointment?" I said, "No. Tell him the new owner of this branch is here." She looked at me. She called him. He came to the door. He saw me. His face went through 3 things in 2 seconds. I said, "Good morning, Greg. I want to have a conversation about your employment status. Hit that like button right now and subscribe if you are new here. Drop a comment telling me where you are watching from. Every week, a new story. Let us start from the very beginning. My name is Marcus Watkins, and I am 57 years old. I grew up in a neighborhood on the east side of Indianapolis that the people who did not live there called rough, and that the people who did live there called home. Both descriptions were accurate, depending on what you were looking at and what you had decided was important. The houses on Brookside Avenue were small, close together, and looked exactly like what they were, houses where working people lived. My father, Charles Watkins, worked at a Ford stamping plant in Indianapolis for 24 years. He worked second shift for most of those years, which meant he left the house at 2 in the afternoon and came home after 10 at night, and I saw him on weekends, and on the mornings before school when he was still at the kitchen table with his coffee and the newspaper, reading in the specific quiet way of a man who had been up since 7 and who was savoring the hours before the day made demands. He was the most reliable person I ever knew, not reliable in the sense of being predictable or boring, reliable in the sense that if Charles Watkins told you he was going to do something, that thing got done, every time, on time, completely. He applied this quality to everything, to his work at the plant, to the maintenance of the house, to the specific promises he made to his children, to the bills that he paid on the first of every month without exception, even in the years when paying them required a careful sequence of decisions about what was possible. My mother, Darlene, worked as a home health aide for 15 years and then as a nursing assistant at a long-term care facility in Irvington for 12 more. She was the warmth in the house in the way that certain people were warmth, not as a performance, not as a deliberate choice, but as the natural output of someone whose first instinct with every person and every situation was care. She was also funny. I want to say that because the humor was part of who she was and part of what she gave me. A dry, specific, perfectly timed humor that came from someone who had seen enough of the world to find it genuinely funny at regular intervals. She could make my father laugh in the middle of a stress that had not yet been resolved, and that laugh was the thing that told both of them they were going to be fine. I have her humor. I use it less than she did because I am a naturally quieter person than she was, but it is in me. There were 3 of us children. My older sister, Renee, 2 years ahead of me, who became a social worker and has been doing that work in Indianapolis for 30 years, and who is one of the most genuinely good people in any room she enters. My younger brother, Kevin, 3 years behind me, who drove for UPS for 20 years and who coaches youth basketball on weekends with a commitment to it that would have made a reasonable person think it was his full-time job. I was the middle one. Middle children got the specific education of watching both directions, watching what Renee figured out first and understanding what that meant for me, watching Kevin arrive and understanding what it meant to be the person who had gotten there before someone needed you to have been there. It made me observant in a way I was not fully aware of until I was an adult, and people started pointing out that I had a specific quality of watching situations before acting in them. I had been doing it since I was 8. School was where I understood what I had. I was not the most naturally gifted student in a room. I was not the fastest with a test or the most comfortable with presentations or the most confident hand raiser. What I had was the ability to understand systems, how things work together, the relationship between parts, why one thing caused another. I could look at a process, any process, and see it as a series of connected pieces rather than as a single undifferentiated thing. My 7th grade mathematics teacher, a woman named Mrs. Howard who was 60-something and who had been teaching in Indianapolis public schools for decades, told my mother at a conference that Marcus has the best systems thinking I have seen at this level. He does not just solve problems. He understands why the problem exists. My mother told me this. She said it the way she said most important things, directly, without performance as information. I said, okay. She said, does that make sense to you? I said, yes. She said, good, then use it. I used it. High school was where I started applying the systems thinking to things that produced something. I got a job at 16 at a small trucking company in Beech Grove, loading and unloading freight, the physical bottom of the logistics industry, and I watched everything. How the freight moved, where the delays happened, what the difference was between the days that ran smoothly and the days that did not, what decisions the dispatchers made, and what consequences those decisions had for the efficiency of the day. I kept mental notes. I graduated high school in 1985, and I went to IUPUI, Indiana University, Purdue University, Indianapolis, on a Pell Grant and a partial academic scholarship. I studied business with a focus on operations management because That was the field that matched what I had been doing naturally since I was a teenager, looking at how things moved and understanding how to make them move better. I worked the whole time. The trucking company job through the first 2 years. Then a warehouse management position at a distribution company in Plainfield through the last 2. That second job was the one that changed my professional direction, because the man who hired me, a warehouse operations manager named Doug Freed, was the first person who had given me significant responsibility early and who had watched what I did with it and had increased the responsibility accordingly. By the time I graduated in 1989, I was supervising a team of 14 at the Plainfield Distribution Center. Doug called me into his office 3 months after I graduated. He said, "Marcus, you have more operational intelligence than anyone I have hired in 12 years. What are you planning to do with it?" I said, "I am thinking about starting something." He said, "In logistics?" I said, "Yes." He said, "What kind of something?" I said, "There is a specific gap in last-mile distribution in Indianapolis that the large carriers are not filling. Small and mid-sized businesses need reliable same-day and next-day delivery within the metro area, and they are currently using a patchwork of courier services that are unreliable and expensive. A company that solved that problem well and reliably would have a real market." Doug looked at me. He said, "You have thought about this?" I said, "For about 2 years." He said, "What do you need to start it?" I said, 2 vans, an operating license, 3 reliable drivers, and about $30,000. He said, "I can connect you with someone who funds early-stage logistics operations. He is not a formal investor. He is a man who made money in freight and who puts money into things he believes in when the operator knows what they are doing." I said, "I would appreciate the introduction." He said, "I will call him today." That call produced a meeting. That meeting produced $32,000 in seed funding from a man named Harold Greaves, who was 64 and who had spent his career in freight, and who spent 45 minutes asking me the most specific operational questions I had ever been asked by anyone, and who at the end of those 45 minutes said, "You know exactly what you are doing. Here is the money. Make it work." I made it work. Subscribe right now. The next section is where the real building starts and where the first major crisis arrives. Watkins Same-Day Logistics launched in March of 1990. 2 vans, 3 drivers including me in the first month, because the budget required that I drive myself, and because I also genuinely wanted to be in the operation at every level before I managed it from any distance. I drove routes in the mornings. I managed dispatch in the afternoons. I did the bookkeeping at night. I slept about 5 hours. I did this for 8 months. The market was real. I had seen it correctly from the Doug Freed conversation. Small and mid-size Indianapolis businesses had a last-mile problem, and they were willing to pay reliably for someone who solved it reliably. The word reliably appears twice in that sentence intentionally. Reliability was the whole product. The service was delivery. The competitive advantage was that the delivery happened when I said it would happen, and that when it did not happen for any reason, I called before the client found out themselves, and I had a solution before the call ended. By the end of 1990, I had 4 vans, 7 drivers, and revenue that covered operating costs with a small margin. By 1992, I had 9 vans and 14 drivers, and my first office space, a rented room in a commercial building on East Washington Street that was small enough that 2 people in it felt crowded, but that had a real address and a real phone line, and the specific credibility of an established business, address that clients needed to see before they were fully comfortable. I hired my first full-time dispatcher in 1993. Her name was Patricia Vance, and she was 27, and she had been working for a commercial moving company for 4 years, and she had the specific combination of organizational precision and interpersonal skill that dispatcher work required. She stayed with the company for 19 years. She eventually became my head of operations. By 1995, Watkins Same Day had 21 vans, 32 full-time employees, and contracts with 47 regular clients across the Indianapolis metro area. This is where I have to tell you about the crisis. Because there was a crisis, and it almost ended everything. In the spring of 1996, I lost my two largest clients in a 3-week period. Not because the service failed, because a national carrier entered the Indianapolis market with a same-day offering, and they lowballed their initial rates to an unsustainable level specifically to pull mid-size clients away from regional operators. They got both of my largest accounts. Those two accounts represented 31% of my revenue. Losing 31% of revenue in 3 weeks, when you are a small logistics company with fleet payments and payroll and insurance and facility costs, was the specific kind of financial event that created existential pressure. I sat at my desk on a Friday evening in April of 1996, and I did the math. The math said, at current run rate, I had 11 weeks before the company was underwater. 11 weeks. I called Harold Greaves. He picked up. I said, Harold, I have a situation and I want your perspective. I told him everything, the lost accounts, the revenue impact, the 11-week calculation, all of it. He was quiet for a moment. He said, what are you planning to do about it? I said, I have 3 options. 1, I can pursue the lost accounts aggressively and try to win them back before the national carrier locks them in with contracts. 2, I can immediately go after replacement clients to fill the revenue gap. 3, I can restructure the cost base to buy more time while I do both. He said all 3 at once. I said yes, they have to happen simultaneously. I do not have time for sequential. He said, what do you need from me? I said, your opinion on whether I am thinking about this right. He said, you are thinking about it right. You are also about to work harder than you have ever worked in your life. Call me when you close the first replacement account. I closed the first replacement account in 8 days. A pharmaceutical distribution company in Carmel that had been using a less reliable regional carrier, and that was experiencing the specific operational pain of inconsistent delivery in a business where delivery consistency directly affected patient outcomes. I got in front of their supply chain manager on a Tuesday. I showed him 6 months of our delivery data, on-time rate, exception rate, resolution time when exceptions occurred, every number. He said, this is the best delivery performance data I have seen from a regional carrier. I said yes. He said, what is your rate? I told him. He said, the carrier we are using now is 10% cheaper. I said, they are also delivering 73% on time. Your current exception rate is affecting downstream operations. I am offering 94% on time and a guaranteed resolution protocol for every exception. The 10% you save now is costing you more than 10% in operational disruption. He said, I need to verify your numbers. I said, call 3 of my current clients. Here are the numbers. He called 2 of them. He called me back that afternoon. He said, you can start Monday. I restructured the cost base simultaneously. 3 difficult conversations with fleet financing companies about payment extension. 1 staff reduction that was the hardest single decision I had made in the company's history. I let 2 people go, both of whom I had hired personally, and I told each of them directly why, and I gave each of them more than the standard notice because they had earned it, and because the situation was not their fault. By week 9, I had replaced the lost revenue. By week 13, I was growing again. The national carrier that had lowballed my biggest clients raised their rates 14 months later when their introductory period ended. One of my original large clients called me. They said, "We made a mistake." I said, "Yes." They said, "Can we come back?" I said, "Yes." The terms were better than the original contract. I never let a single client represent more than 15% of revenue again. That was the operational discipline the 1996 crisis produced. Every crisis produces a discipline. The discipline of the 1996 crisis was diversify the revenue base until no single loss is existential. I applied this discipline for the next 30 years. By 2000, Watkins Logistics Group, I had rebranded and expanded into warehousing and fulfillment by then, had revenue of $8.4 million and 67 employees. By 2005, we were at 19 million. By 2010, we were at 41 million. The growth was not dramatic, it was consistent, year over year. Project by project, client by client. The systems thinking that Mrs. Howard had identified in 7th grade applied at scale. I could look at a logistics operation of any size and see where the friction was and what it would take to reduce it and what the financial impact of reducing it would be. I was genuinely good at what I built. I want to say that plainly because I think people sometimes understate the role of genuine competence in building something real. Ambition and work ethic are necessary. Genuine competence is what makes them sufficient. I was genuinely good at logistics operations. And I was building the company, account by account and acquisition by acquisition, towards something much larger than the Indianapolis metro operation it had started as. Stay with me. The next section is where the personal life gets complicated and where the betrayal arrives. I want to tell you about Diane. Not because the marriage needs to be a long section of this story, but because Diane's presence in my life for 14 years shaped what came after in ways that mattered, and because the honest version of this story includes the full picture. I met Diane Morrison in 1998 at an industry event in Chicago. She was an account executive at a freight brokerage that handled some of the same client types I worked with. She was 32, direct, sharp, and had the specific confident energy of someone who was very good at her job and who knew it without needing anyone to confirm it. We dated for 2 years. We were married in 2000. Those were genuinely good years. The early marriage years and the growth years of the company coincided in a way that made both feel amplified by the other. Diane understood business in the specific way of someone who had been in operations her whole career. She could engage with the company in real terms, ask real questions, give real feedback. Dinner table conversation was the most useful business conversation I had in those years. We had a daughter, Tamara, in 2003. Tamara was the specific combination of both of us, Diane's confidence and my patience, and her own specific quality that was entirely her own. A clarity of observation that showed up before she was 3 years old, and that has been one of the most reliable things about her in the 20-plus years since. The marriage started to shift in 2008. Slowly at first. The specific slow shift that happened when two people who were both building things externally stopped maintaining the thing between them with the same attention. I was deep in growing the company. Diane had moved into a consulting role that was consuming in a different way. The conversations that used to be about what we were each building became conversations about logistics, schedules, responsibilities, who was getting Tamara from where. The infrastructure of a household managed by two busy people rather than a genuine exchange between two people who were still interested in each other. We both knew it was happening. We talked about it twice, in the way of people who were handling a situation that required more than two conversations, but who were both too consumed by other things to give it the sustained attention it actually needed. The marriage ended in 2012 with less conflict than it deserved. I say that honestly. We separated without ugliness because by the time we separated, there was not enough there to fight about. The care had become administrative. Ending it was the honest acknowledgement of something that had already ended in the ways that mattered. Tamara was 9. She handled it the way Tamara handled everything, by asking direct questions and by evaluating the answers with the specific clear-eyed assessment of a child who had inherited her father's systems thinking and her mother's directness, and who was going to make of this situation what she decided to make of it. She decided to be fine. She was. I was a full presence in her life through all of it. Every week, every school event, every conversation she wanted to have. She grew up knowing both her parents were genuinely present even in separate households, and she grew up watching me build something that she eventually started asking real questions about. The company by 2012 had expanded into 3 states: Indiana, Ohio, and Kentucky. We were doing regional warehousing and fulfillment in addition to the same-day delivery operation that had started everything. In 2013, I made the acquisition that changed the company's scale permanently. A regional freight carrier in Columbus, Ohio, called Mid-State Transport that had been in operation since 1982, and that was in financial distress after losing 2 major contracts. The bones of the company were excellent. Real fleet, real infrastructure, real operational people who knew how to move freight. What was wrong was the management layer and the capital structure, both of which I could fix. I bought it for $11 million using a combination of company cash and a commercial real estate loan from a bank in Columbus that I had relationships with. Not from First Community Bank in Indianapolis. I had tried First Community Bank in Indianapolis first. Greg Paulson had been the manager at that branch for 4 years. I walked in with a complete loan application for the Mid-State Transport acquisition, detailed financial statements, the acquisition thesis, the integration plan, the projected post-acquisition performance, a genuinely well-constructed application for a well-structured acquisition. He looked at it for 4 minutes. He said, "We don't help people like you." I walked out. I got the loan from Columbus 2 weeks later. I acquired Mid-State Transport. I integrated it. By 2015, Watkins Logistics Group had combined revenue of $67 million and operations in 6 states. By 2018, we were at $94 million. By 2022, we crossed $120 million in annual revenue, and I had 312 employees, and a company that was recognized as one of the 10 largest regional logistics operators in the Midwest. Greg Paulson was still at First Community Bank on Meridian Street. He had no idea what had happened to the man he had dismissed in 6 minutes in 2013. And I had not forgotten what he said. "We don't help people like you." Subscribe right now and keep watching, because the next section is where that sentence gets its answer. The decision to buy the First Community Bank branch was not impulsive. I want to be clear about that because what it looks like from the outside, man gets rejected, man buys the bank, man fires the manager, looks like a revenge fantasy playing out in real life. The mechanics of it were real, and the sequence was real, but the decision was not emotional. It was strategic. In 2022, I had been thinking for 2 years about the next phase of Watkins Logistics Group's growth. The company had crossed $100 million in revenue, and the next level of growth required a different kind of capital access than what I had been using. Real estate acquisitions for expansion, fleet upgrades at scale, working capital facilities large enough to support the payment cycles of the institutional clients we were starting to attract. I needed banking relationships that matched the company's actual size, rather than banking relationships that matched what I looked like to a branch manager in 2013. My CFO, a woman named Sandra Park who had been with the company since 2015, and who had the specific clear-eyed financial intelligence that CFO work required, had been mapping the regional banking landscape for 6 months. She presented her analysis on a Tuesday in October. She said, "There are 3 underperforming bank branches in the Indianapolis metro area that could be acquired at attractive valuations. The parent holding companies are actively looking for buyers. One of them is First Community Bank's Meridian Street branch." I looked at the analysis. I said, "Tell me about the Meridian Street one." She said, "The branch has been running at 68% of its peer performance benchmark for 3 years. The holding company has been trying to sell it quietly for 18 months. The asking price is manageable and the deposit base is real." I said, "What would we do with a bank branch?" She said, "We would operate it as a financial services subsidiary. The deposit base provides low-cost capital. The commercial lending license allows us to structure internal financing for fleet and real estate without going to third-party lenders for everything. It also gives us a platform to serve other mid-sized businesses in the region who have the same banking access problems we have had." I said, "Is there a personal element in why this specific branch is interesting to me?" She looked at me. She knew about the 2013 loan rejection. She had heard the story when she was doing her initial due diligence on the company before joining. She said, "Yes." I said, "Does that affect the analysis?" She said, "The analysis stands on its own. The personal element is a bonus." I said, "Yes, it is." I had my attorney reach out to the holding company within the week. The acquisition process took 6 weeks. It was a real transaction with real due diligence and real regulatory process. Community bank acquisitions required approval from the relevant banking regulators, and the process was methodical and specific. We worked through all of it correctly. The closing happened on a Wednesday morning. My attorney, Sandra, and I were at the title company at 9 in the morning. The documents were signed. The wire transfer was confirmed. At 10:30, I drove to the branch on Meridian Street. I was alone. I had not brought anyone with me. This was not a performance, it was a conversation. I walked in. The branch had 12 staff members working that morning. Several of them recognized me as someone who had been coming and going during the due diligence process. I went to the manager's office. His assistant, a woman named Robin who had been with the branch for 11 years, was at her desk outside. She said, "Mr. Watkins." I said, "Robin, is Mr. Paulson in?" She said, "Yes, he is. Do you need me to announce you?" I said, "Please tell him the new owner of this branch is here." She looked at me. She had not been told who the buyer was during the acquisition process. The seller had maintained confidentiality. She called Greg. He came to the door in about 30 seconds. He saw me. His face went through recognition, confusion, and then the specific physical stillness of someone whose system is processing something it was not prepared for. He said, "Marcus Watkins." I said, "Greg, yes." He said, "You." I said, "Me." He said, "You bought the branch." I said, "Closed this morning." He said, "You." I said, "Me." I said, "Can we sit down?" We sat in his office, the same office where he had kept me waiting for 4 minutes before calling me in 9 years earlier. I said, "In 2013, you looked at a complete commercial loan application I submitted and you said, and I want to make sure I am quoting this correctly, we don't help people like you." He said nothing. I said, "What did you mean by that?" He said, "Marcus." I said, "What did you mean by that sentence?" He looked at his desk. He said, "I made an assessment that the application did not meet our criteria." I said, "The application met your criteria. I had it reviewed afterward by 2 commercial lenders who approved essentially the same application with comparable terms. The application met your criteria, and you chose not to extend the loan." He said, "I may have been too hasty." I said, Too hasty. I acquired the company I was trying to finance with a loan from a competitor bank. The acquisition produced returns that are documented in public filings. The application was sound and you rejected it. He said, I understand. I said, I am going to tell you what I think happened. He waited. I said, you looked at me and you made a decision about who I was based on what you saw. A black man in his late 40s from Indianapolis applying for a commercial loan to acquire a freight company. You decided, on the basis of what you could see, that I was not the kind of customer this branch served. That is what we don't help people like you means. He said nothing. I said, you were wrong about the loan application, and you were wrong about what we don't help people like you means, and I want you to sit with both of those things. He said, I understand. I said, I am going to make a decision about your employment now, and I want to explain the decision so it is clear. He said, okay. I said, this branch has been underperforming for 3 years. The branch performance data shows a pattern of inconsistent commercial lending decisions and a client retention rate that is below the peer benchmark. Some of that is structural and can be fixed with different leadership. Some of it may be cultural, meaning the culture of how this branch treats potential clients. I said, I am terminating your employment effective today. Your severance will be calculated according to your employment agreement. Robin outside will handle the logistics. He said, Marcus. I said, I want to be clear that this decision is a business decision. I am going to put leadership in place who can turn this branch around. That requires a leadership change. This would be true regardless of the history between us. He said, but the history is part of it. I said, yes. The history tells me something about the culture this branch developed under your management. It tells me something about how people who looked like me were treated when they came through that door with sound business proposals. The history is part of the data. He said, I made a mistake. I said, yes, multiple ones, and the consequences of those mistakes are real. He was quiet. He said, I did not know who you were. I said, I know. I said, that is the whole point, Greg. You were supposed to be evaluating what I brought through that door. Instead, you were evaluating who you decided I was before I sat down. He said nothing. I stood. I said, Robin has the paperwork, I wish you well. I walked out. I walked to the main floor of the branch. The 12 staff members were going about their morning. Robin was at her desk with an expression that communicated she had understood most of what had happened and was processing it. I said, Robin, I want to have a brief all-staff meeting in 15 minutes in the main area. Can you please let everyone know? She said, of course. I stood with the branch staff for 20 minutes. I told them the branch had new ownership and new direction. I told them their positions were secure and that the change in leadership at the management level was not a reflection on them. I told them what the next 30 days were going to look like and who they would hear from in terms of transition communication. I told them one more thing. I said, this branch is going to become known as the community bank that actually serves the community it is located in. Every client who walks through that door with a sound proposal is going to be evaluated on the merits of the proposal. Every time. They were quiet. Then Robin said, that would be a change. I looked at her. She said it directly, matter of fact. The specific honesty of someone who had been watching something for 11 years and had the specific relief of being able to say it. I said, yes, it would. Subscribe right now and stay here for the last section, because the final part is where everything lands. The branch became something different over the next 18 months. I hired a new manager, a woman named Christine Holloway, who had spent 12 years in commercial banking in Cincinnati, and who understood both the financial mechanics and the community orientation that I was trying to build into the branch's identity. Christine spent the first 60 days doing what I had asked her to do, which was talk to people. Business owners in the Meridian Street neighborhood and the surrounding Indianapolis East Side commercial corridor. People who had businesses, who had loan needs, who had been to banks before and been told no in various forms. The picture she assembled confirmed what I had expected. There was a real market of credit-worthy small and mid-sized business owners who had been systematically underserved by the conventional banking approach to commercial lending. Not uncreditworthy, underserved. The distinction was real, and it was important, and it was the distinction that the branch's previous management had not understood or had not cared about. Christine built a commercial lending program designed specifically for that market. The underwriting criteria were sound. She was not taking reckless risks. What she was doing was taking the time to understand businesses that did not fit the conventional template and to assess their creditworthiness on the basis of their actual performance, rather than on the basis of whether they matched a pattern the system was designed to recognize. In the first 12 months of the new program, the branch made 47 commercial loans. 31 of those loans went to Black-owned businesses in Indianapolis. The default rate on the entire portfolio at 12 months was 4.2%. The benchmark default rate for comparable community bank commercial portfolios in the region was 5.8%. The underserved market was, in fact, a lower credit risk than the conventional market the branch had been serving. That fact did not surprise me. It confirmed what I had believed for 30 years of running a business and needing capital. The people who were being told no were often the people who knew exactly what it cost to fail, and who therefore took their obligations more seriously than people for whom failure had softer consequences. Tamara came to visit the branch in the second year. She was 21. She was finishing her business degree at Butler University. She walked through the branch and asked Christine questions with a specific systematic curiosity she had been applying to everything since she was 3 years old. Afterward, she sat with me in my office at the Watkins Logistics headquarters. She said, "Dad, what made you buy a bank?" I said several things: strategic capital access, the community opportunity, and a personal reason that informed the strategic ones. She said, "Greg Paulson." I said, "Yes." She said, "The 'we don't help people like you' sentence." I said, "Yes." She said, "You carried that for 9 years." I said, "I kept it. Carrying is not quite right. I kept it in a specific mental folder the way I kept other information that was going to be relevant at the right moment." She said, "And the moment arrived." I said, "The moment arrived when the branch came available and the strategic case was sound." She said, "Both things at once." I said, "Usually the best decisions are the ones where multiple things are true simultaneously." She said, "Is this what revenge looks like?" I said, "I would use a different word." She said, "What word?" I said, "Completion." She thought about this. She said, "Because it closed something." I said, "Because it turned something that was meant to diminish into something that built." The loan Greg Paulson rejected produced the company that bought his branch. The branch is now producing capital for businesses that Greg Paulson would have rejected for the same reason he rejected me. She said, "So the rejection became the thing that helped other people." I said, "Yes." She was quiet. She said, "That is better than revenge." I said, "Yes, it is." She was quiet for another moment. She said, "Dad, can I tell you something?" I said, "Yes." She said, "I knew something was different about you after you bought the branch. The way you talked about it. There was something settled in you that was not there before." I said, "Yes." She said, "The unsettled thing was that sentence." I said, "Yes." She said, "It stayed in you for 9 years." I said, "Not actively, in the background." She said, "And now it is gone." I said, now it is gone. She said, good. She said it simply, like her grandmother would have. I have been in the logistics business for 33 years. I have been in banking for 4. The combination is not something I planned in 1990 when I was driving routes with 2 vans in Indianapolis. But the path from those vans to a $120 million logistics company to a community bank branch on Meridian Street is a straight line if you understand what connects the points. Every step was the result of the same thing. Seeing what was needed, building what could fill it, doing the work completely. The morning I walked into Greg Paulson's office and ended his employment, and then stood in front of 12 branch staff members and told them the branch was going to serve the community it was in. That morning was not the morning I won something. I had already won, years before. That morning was the morning a sentence got answered. We don't help people like you. The answer turned out to be a branch, a community lending program, and 47 loans in the first year to businesses that other banks had decided were not the kind of help they provided. That is the most complete answer I can give to what Greg Paulson said in 2013. I want to leave you with the thing that actually matters in this story. The $85 million acquisition and the fired branch manager and the bought bank. Those are the dramatic moments. Those are the scenes that make a story. The actual thing is simpler. I drove a delivery van in Indianapolis when I was 24 years old, and I watched how freight moved, and I asked questions about why it moved that way, and I spent 33 years applying the answers to every decision I made. That is it. The systems thinking that Mrs. Howard identified in 7th grade. The reliability that my father demonstrated for 24 years at the Ford plant. The care that my mother brought to every person she served as a home health aide and a nursing assistant for 27 years. I am what those 3 things produced. The company and the bank branch and the specific moment in Greg Paulson's office were downstream of those 3 things. Greg said, we don't help people like you. He was right that he did not help people like me. He was wrong about what people like me were. People like me were Charles Watkins showing up to second shift for 24 years because his family depended on it. People like me were Darlene Watkins serving patients who needed care because the care mattered. People like me were the 31 black business owners in Indianapolis who received commercial loans from a branch that their parents and their grandparents and they themselves had walked past for decades without being able to access it. People like me build things. We always have. The difference is that this time the branch that said no became the branch that said yes. And the man who said no found out that the man he rejected had been building something for 9 years that was going to come right back through that door. Drop a comment right now and tell me something. Tell me about a time you were told no. Tell me what you built after. Tell me where you are watching from. I read everything. Hit that like button. Subscribe to this channel. Every week I come back with a new story, and every story is worth your time. Thank you for being here.